Hello, folks. Today I want to talk about the oil industry and oil's significant rise this week. Today we saw oil rise over $73 per barrel, and we strongly believe that this rise will continue at least until $80 a barrel. Many experts believe that oil could also rise to $90 a barrel in the coming months. This is all supported by the fact that we're in a bit of an energy crisis right now. Oil, as a commodity, is in high demand, but supplies are low. Inventories across the board here in the States and in the Middle East and other oil producing areas all show dwindling inventories. Now, production is ramping up, and that gap should eventually be overcome. However, right now, prices are being driven up because of a lack of supply, and that should continue at least for the next couple of weeks or months. That, coupled with the fact that many regions are entering their colder months, demand should further increase, which puts even more pressure on the dwindling supply. Simple laws of economics, price of oil is going to rise. As such, that sets us up for some very interesting options plays. Our first options opportunity that I want to talk about stems around the company Baker Hughes. Baker Hughes is a oil and gas equipment company. They're essentially got their hands in a little bit of refining, a little bit of management, a little bit of pipeline, a little bit of switches, a little bit of this, a little bit of that. Really significant presence in the oil industry. They have a number of operational rigs and are one of the biggest U.S. suppliers of operational oil drilling rigs in the Permian Basin and many other oil producing regions in other parts of the world. That said, with production increasing, Baker Hughes's rig count is going to increase. In fact, it's been up incrementally 7 weeks in a row now. We expect that to continue. We also expect them to have more service contracts, supply more parts, and essentially just have a really good quarter based on the demand for oil and the fact that they're going to be one of the main contributors bringing the supply to the masses. So with that setup and bull case in mind, the options that I'm looking at right now are the October 2021 $26 calls that expire on October 15th, 2021. Now I'll repeat that. We're looking at the Baker Hughes October 2021 $26 call options. Now these expire on October 15th, giving us roughly 3 weeks in the trade. The strike price again is $26. Our premium as I'm recording this is roughly 30 cents per share, or for one contract you're looking at $30 total. So it's fairly cheap. Max loss, if this expires worthless, is $30 per contract. Again, it expires on the close of trading on October 15th, 2021. This is an active management strategy, and we will be actively watching the price as the underlying stock, Baker Hughes, moves closer towards our strike price of $26. If, unfortunately, the underlying stock, Baker Hughes, begins to slide away from our $26 strike price, we will actively manage that to minimize our loss and not take the full loss of $30 per contract. Upside potential here, we could potentially lock in upwards of a 200 to 300% gain if everything falls into place, especially if we're in the money early. Again, our strike price is $26, and that's going to be a key factor we're going to watch over the next few weeks in the underlying stock as we approach expiration on October 15th, 2021. And that is our first options trade based off the oil bull case that I laid out for you a moment ago. For our second trade, I want to look a little further upstream the oil and gas pipeline at Chevron Corp, ticker symbol CVX. With operations in both drilling and refining, this company can essentially double dip on the oil's up price surge. This gives us a good chance of watching an upswing in the stock and an opportunity to capitalize again on a call option opportunity. CVX is one of the most fundamentally sound companies, which is great to support our bull case in oil and this company as a whole. But what really sets up this options trade is the technical factors. The stock has been consolidating considerably over the past 2 months, and I really like the momentum that we're seeing in this bounce that just started this week. I think that can carry on, and we might see a little pullback halfway along the way, but I think without a doubt, we can reach upwards of 106, 107 per share over the next month or so. Because of that, I'm looking at the October 2021 104 calls that expire on October 22nd. Again, this is the October 2021 calls for Chevron CVX with a strike price of $104, expiring at the end of trading on October 22nd, 2021. As such, the premium right now is a $1.17 per share, or per contract, we're looking at a total of $117 per options contract. That said, I think we could more than double our money here with 100% gain at minimum, considering things break our way in the next few weeks, as I expect they will. However, if unfortunately things don't and the price slides away from our 104 strike price, we will have the opportunity to offload this before we take a full loss of $117 per contract and minimize those losses. So again, this is an active management strategy. It'll be a fast moving one. Gives us about 4 weeks in this trade before it manifests. Again, just to reiterate the technicals of this trade, we're looking at the Chevron CVX October 2021 104 strike price call options that are expiring on October 22nd, 2021. Thank you again for watching, and I'll be back at you with some updates on how these trades are going and how we're going to actively manage them in the upcoming updates. Thanks again, and have a great weekend. Take care.